Hello and welcome to New Economic Thinking. I'm here today with Professor Kevin Gallagher, a professor at Boston University and also an INET grantee. Kevin, thanks for being with us.
Thanks for having me here.
I'm here to discuss your new book, which is called Ruling Capital. Why don't you explain to the viewers what the main thesis of the book is?
The main thesis of the book is that in the wake of the financial crisis, there's been all this new economic thinking and new economic practice.
And we're talking about which financial crisis, to be clear? We're talking about the one in 2008.
Yeah, well, let's
there's a number of them. So
yeah, I continue. That one to me, it keeps rolling in different forms and in different places. But yeah, the crisis in 2008. Ever since then, emerging markets have re-regulated cross-border finance, bank loans, derivatives, stocks, bonds and so forth, flying into their country, flying out. So a big story in the book is, one, there's new economic theory and evidence that shows that that kind of regulation is more justified now than ever, that some emerging markets went ahead and did it, and they also carved out some policy space to be able to do it under the IMF, which had traditionally been pretty hostile to this kind of regulation.
In some respects, even though it's bad for our branding, it's old economic thinking to the extent that we're going back to a world where capital accounts are much more regulated, which is very contrary to the prevailing orthodoxy that we've had in financial markets for the last 30 years.
Sure, folks like Keynes and Minsky definitely saw very early on that if you fully open up the capital account, it can create volatility and financial instability and really affect the trading system, the real economic policy and real economic activity that we want. But there's been some real new economic thinking too. The economic thinking of the 90s was let capital flow and economies will grow. That emerging markets inherently needed more capital, so let it in, and it would automatically help them grow. And that the way to get it, in addition to opening up your capital account, was to do good market fundamentals, good monetary policy, good fiscal policy, and it would come.
And let the markets fend for themselves, so to speak. Actually, you have a rule of law, you have proper regulation, and then the government basically steps out at that point.
Yeah. And
the so-called Washington Consensus.
Yes, the Washington Consensus, and that's really been challenged both inside and outside the mainstream of economic theory in the past 10 or 15 years, and from some other INET grantees.
Now, it's interesting because what a lot of people will say today is, given the extent to which we have liberalized capital accounts around the world, and you know, the fact is nowadays you could have financial flows moving at the push of a button. And yet your book contends that it is still possible in this kind of environment, even though Pandora's box has been opened, to re-regulate and to control those capital flows.
Yeah, that's what's so fascinating. So many emerging markets, Brazil, South Korea, Indonesia, Taiwan, Peru, all put in place a new generation of foreign exchange derivative regulations, new regulations on stocks and bonds, and econometric work that I did for the book and that other folks have done at the IMF and so forth has shown that these regulations have been able to help. As a matter of fact, the IMF did a big study that showed that those countries that regulated capital inflows before the 2008 crisis were among the least hard hit.
Now, I jokingly said before which crisis, and the reason I said that was in part to be flippant, but in part because you contrast this period with the period of the so-called Asian financial crisis, 97, 98. And in your book, you make a lot of reference to that, and you contrast the policy biases that were in play at that time compared to what you have in 2008, especially the role of the IMF, which has changed quite markedly.
Sure, both economists and the IMF really said, open up your capital accounts, let it flow in, and you're going to grow. Now, though, the IMF has done a lot of new economic research, and the econometric evidence shows that those countries that opened up their capital accounts didn't grow.
And interestingly enough, one of the figures who was key to that earlier call for capital account liberalization was Stanley Fischer, who was then, I think, deputy head of the IMF. And he's now a deputy head of the Federal Reserve. He's a most interesting character in that regard, because he does seem to have really undergone a Damascene conversion.
Yeah, he really has done an about-face, because he learned firsthand. After he went from the IMF, he went over to be the head of the Central Bank of Israel, an emerging market that after the 2008 financial crisis, when U.S. interest rates were really low, there was a major expansion of credit into emerging markets, and his country really saw a lot of vulnerabilities with the exchange rate appreciating significantly and a massive expansion of credit. But then once interest rates started to go up and China started to slow down, the currency started to depreciate, and all of a sudden you have to come up with more local currencies to be able to pay those debts, and there's real financial instability there. So Stanley Fischer at the IMF a year ago was part of a panel with Olivier Blanchard and others that said, hey, we really need to be regulating this stuff. And interestingly, going back to Keynes in 1944, Fischer, Blanchard, and others said it has to be regulated at both ends. Not just in Israel, Indonesia, and South Korea, but there needs to be some way to regulate it up in the north, in the United States. Because one of the new economic observations after the 2008 crisis has been that it's actually not the fundamentals of the countries in the emerging market and developing countries that are what are the determinants and what draws these financial flows. It's actually the federal funds rate. When the federal funds rate is really low and the VIX, the indicator of volatility in the markets, starts to go down and seems calm, that's when there's a massive expansion out to emerging markets. And unfortunately, you get big surges.
That's you, and you alluded to that. You talk about the so-called carry trade, effectively people borrowing heavily in dollars because the dollar's interest rate structure is so low, and then investing that money into high-yield emerging market currencies.
Sure. Ben Bernanke hoped that low interest rates in the United States and the unconventional monetary policies were going to spur folks like you to open up new restaurants in Manhattan or new factories in Nebraska, but since there wasn't the demand there, banks were reluctant to lend to that kind of economic activity. It's one of the reasons why we've had a slow but hopefully starting recovery. Instead, hedge funds in Manhattan and so forth would say, hey, interest rates are practically zero in the United States, but in Brazil they're 12.5%. So I can borrow in the US, buy Brazilian real, get the carry, which is the 12 percentage point spread, but then I can bet against the dollar and bet on the Brazilian real. And if I'm highly leveraged, there's a lot of money to be made for that individual. However, that individual doesn't quite feel the effects of how that can affect systemic risk in a country like Brazil.
Yes, because you get the hot money coming in. Usually these funds go into economically marginal projects. In the late 1990s, I was actually working in Asia, and you had a lot of speculative money going into the property markets, and so this helps to create huge bubbles in real estate, and that was a major byproduct of the movement of these capital flows in that period. And I'm sure the same thing was happening in the 2008 period.
Yeah, absolutely. 2008 to about 2012, 2013, massive exchange rate appreciation and massive expansion of credit, too much so in creating bubbles in many emerging markets.
And we had it in the commodities complex as well. I mean, you had that classic illustration in the oil market in 2008. After we'd had the first instance of some form of, well, the maintenance of these low interest rates and funds flowing, taking money, putting them in and speculating in the crude markets, which had a real economic impact, I might add, because obviously when you go from 80 to 140 in the space of 6 months, it does tend to impact.
Yeah, and now the reverse is happening. So we're starting to see interest rates, at least talk of them going up. The U.S. economy is growing. Emerging markets are slowing down. China's slowing down. And so, and obviously the prices of commodities are starting to slow or at least stabilize. And so those investors that were speculating on emerging markets and developing countries are now changing their positions, and there's capital flight outward. That creates depreciated currencies, but you still have all this debt in dollars. So you have to come up with more pesos or more yuan to be able to pay this back. The BIS estimates that there's about $2.6 trillion worth of debt and securities out there right now, and $3.1 trillion worth of bank loans, most of it denominated in dollars.
What about the establishment of these dollar swap facilities, which came about in the aftermath of the 2008 crisis? Do you think that is one of the ways that we can help to alleviate the impact of these wild speculative flows?
Sure, definitely when they're on their way out, when there's a sudden stop and all of a sudden there's going to be a retreat because there's a panic in the market. The swaps that the Fed did and also that the People's Bank of China did in China were very effective, not necessarily because countries use them, not many countries use them, but just to know that the Fed is right there to back you up if you need it, sent a signal to calm markets down to a certain extent.
It wasn't extensive in the sense that I think Brazil gained access, amongst the emerging markets, Brazil gained access. I think Mexico was another.
South Korea.
South Korea. But it wouldn't have helped, say, a country like Indonesia. So they, for example, had to take other measures.
Yeah, they had to take other measures. They put regulations on the outflow of capital that were fairly significant. The key thing is to prevent the buildup beforehand, to be prudential, to have prudential regulations that reduce the inflows so that when there is some sort of a sudden stop and there's some sort of an outflow, then you don't have, you're not as exposed.
And how do you do that? Because of course, as you point out, it feels good. You know, when the money goes in, you know, you can bring your own interest rates down, investments coming into the country, it may be marginal, but it's while a bubble's going on, it's a great feeling for everybody. So how does a policymaker cope with those inflows?
The key thing is to have a piece of permanent legislation that operates, that allows the financial authorities to flexibly adjust the regulation. So in South Korea and Brazil, the central bank and the finance ministry have a regulation on the books that says, hey, when foreign inflows get to a certain level, we can turn up the spigot here and stem them. But when they start to draw off, you pull it down. And so South Korea put in stiff foreign exchange derivatives regulations on the inflows of dollars at 2010, 2011, but now that they're starting to be outflows, they've reduced those regulations. And it allows the authorities to act quickly and somewhat autonomously. If you're trying to pass a bill through the legislative process to regulate capital flows as they're coming in, as we know here in the United States, those things take months, but these flows come in and out in minutes and hours.
Is that a better way to go? I go back, for example, to the experience of Chile in the early 1980s, and that I used to always think was a very good model for other emerging markets, in the sense that they taxed inflows,
right,
and the rates variability was dependent on the length of time in which these funds were in. So, for example, 3 months you got a higher tax threshold. After a year, the tax rate went to virtually zero. The theory being that you could distinguish between the FDI, the so-called foreign direct investment flows, and say hot speculative money.
Sure, that's one of the most innovative regulations that's out there, and it's an example of what I was talking about. It's on the books, they can use it when they need to, and when capital flows are really short-term, a certain amount has to go into a account at the central bank and be held there for a certain amount of time just in case there's a big outflow. One of the challenges to these regulations that I talk about in the book is that increasingly trade agreements are now regulating the capital account. We think trade agreements are about t-shirts and cars and so forth, but tariffs are so low on all that stuff. Now investors are starting to look at regulations as barriers to trade. And in U.S. trade treaties, like the United States-Chile Free Trade Agreement, they didn't like these innovative laws that the Chileans had, and they're actually outlawed. As we negotiate something called the Trans-Pacific Partnership Agreement.
That's a major consideration. In fact, you're getting a real case of mission creep, because as you pointed out, trade, we've effectively derived most of the benefits from free trade. Tariffs are down to virtually nothing. So now it appears that the U.S. and some of its partners are actually going after these very capital account regulations that you've discussed because they don't like them, and so they are incorporating them into trade agreements.
Yeah, as we've made major gains over the past couple of years at the International Monetary Fund, where they have a new institutional view that sanctions regulating capital flows, and they actually made sure that Iceland did in its country program, and they recommended and endorsed Brazil and South Korea's. At the same time, we've got trade treaties now that are outlawing these same kind of regulations. Not only is there a mission creep on trade, but there's an inconsistency in the Bretton Woods institutions on these things.
Which does make one feel somewhat relieved that they haven't actually come to fruition yet, because that could potentially introduce another form of systemic instability if they were allowed to pass, because you would have to effectively dismantle some of these regulations that you've proposed here.
Yeah, indeed.
I was just going to say, you talked about one of the things that would be required is a countervailing monetary authority in order to make these capital account regulations effective. Do you want to elaborate on that?
Well, yeah, I developed something called a theory of countervailing monetary power, which derives from John Kenneth Galbraith's theory of countervailing power, which he talked about how American capitalism would be successful if there's some sort of countervailing power between capital and the public to be able to distribute the benefits. And I sort of took that to monetary policy and international capital flows and said that capital flows are so strong, there needs to be some sort of countervailing power to be able to balance the benefits and the risks between these. And when it comes down to emerging markets, it's really difficult to do that for the reasons you said. They're so technologically sophisticated. And the interest groups that would have to pay and would be hurt by regulations are some of the strongest interest groups in the world. And so what you need to...
Especially Wall Street.
Especially Wall Street.
Yeah.
And so what you need to do to be able to have countervailing monetary power is, first, like I said, you have to have permanent regulations that allow the monetary authorities to be able to do these things autonomously without having to pass a bill and face an onslaught of lobbies.
And then make sure that they're not, the lobbyists, and then make sure that they're not subverted through trade agreements. You know,
and you have to make sure you've got the policy space in trade agreements, among other things.
Let me change tack a little bit here. You've been in New York the last few days. You've been at a United Nations event discussing the Argentinian debt problem. I'm wondering if you would care to elaborate some of your thoughts on that.
Yeah, the United Nations is thinking about negotiating a sovereign debt restructuring regime. And what I talked about is sovereign debt restructuring is also a way to manage the capital account at its most dire point. And through trade treaties, countries that are restructuring their debt are being taken to private tribunals by vulture-like funds to recoup the full value of their bonds.
And Argentina is a perfect illustration of that. We had a discussion recently with the Argentinian ambassador, and she pointed out, for example, that Argentina is not being a scofflaw. It has secured agreement with 93% of its creditors. It wants to pay that money. In fact, the money is actually sitting in an escrow account in the Bank of New York, and there's one fund which has blocked the agreement. So a New York judge has effectively affirmed that attempt to block the distribution of these assets. So you have effectively one fund which is preventing repayment to the 93% of the other creditors who have agreed to it.
Yeah, and some of those 7%, in addition to fighting in the New York courts, are using trade treaties to try to get the rest of the money from Argentina. There's a bilateral investment treaty between Italy and Argentina, where 60,000 bondholders have hired a law firm, and they are suing Argentina under the bilateral investment treaty for the full value of their bonds, claiming that the treaty, that the haircut is basically an expropriation. And metaphorically, it sort of is, right? Expropriation is supposed to be, well, let's make sure that someone doesn't confiscate the oil company that's here. But creative lawyers have said, actually, a haircut from a bond restructuring is a equivalent of an expropriation. What's more alarming to me than the Argentina case is that there's now a case against Greece by a bank from Slovakia. Slovakia and Greece have a bilateral investment treaty that also says you can't expropriate capital. It defines capital very broadly now. It's not just these big oil companies, but it's bonds and government securities and so forth. And after the Greek restructuring, which this time, unlike Argentina's, was actually negotiated by the ECB and the International Monetary Fund and the EU, with a negotiated haircut with most of the bondholders tendering, Podstava Bank from Slovakia is suing the Greeks, the Greek government directly, for over $1 billion because they are claiming that Greece's sovereign debt restructuring was an expropriation of their property. So it's these treaties are becoming a new avenue, in addition to the New York court rulings, for holdouts to be able to try to get the rest of their bonds at full value, even though the majority of holders are tendering.
So it sounds as if we have, even though we have a lot of sensible policies that have been reintroduced by these countries, there are clearly substantial forces marshalling against their implementation, either through the court system and or through the international trade treaties.
Yeah, there's an economist at the University of Denver named Eileen Grable that says...
oh, I know Eileen, yes.
She says that we're in a moment of productive incoherence, that there are all sorts of productive new regulations going on, but they're incoherent. On the one hand, you've got interesting things at the IMF, interesting regulations in the U.S. in some parts, sovereign debt restructurings going on, but on the other hand, you have this court case in New York, you have these trade treaties that are conflicting with all this, and there isn't much coherence here here. And my last chapter in the book really tries to struggle with that, because this G20 was elevated in the wake of the 2008 crisis to try to create more coherence and coordination. And it had some really great moments in the beginning, but it's really lost a lot of its luster, and it isn't really looking at some of these mismatches and mission creeps.
You just get policy fatigue coming in at a certain point, and I think in the absence of crisis, a lot of the parties who mobilize against these type of agreements, they never give up, and there's only so much political will to use to maintain the momentum, and that's going to be an ongoing challenge, I think, as we go forward.
Yeah, it's a real problem.
Kevin, thanks for coming today. You've obviously raised a lot of important issues, and I do hope that it's a book that's widely read by policymakers all across the globe.
Well, thanks to INET for helping me do this new thinking, and thanks for having me on the show.
It's a pleasure.